What's up, everyone? It's Eric from Option Edge, and today I want to talk about one strategy that will help you become better than every Robinhood trader out there. Okay, and what strategy am I talking about? I'm talking about buying debit spreads versus buying straight up calls. Okay, so I recently heard a interview by Vlad, the CEO of Robinhood, and what he said was that the majority of traders that trade options only are buying single leg options. Okay, so these traders are just saying, "I think the stock's going to go up, so I will buy a call." They think the stock's going to go down, so they buy a put. Okay, overall, that is a losing strategy. Okay, and I'm going to show you today why that is a losing strategy. Okay, so first, I have Palantir open as an example stock. So what we're going to do here is we are going to simulate what it's like to buy. Today's date is September 8th. So let's say 30 days from today, we want to buy the 40 delta call. Okay, so let's go into the options chain. So 40 delta, let's say. All right, so we're trading at $26. So all right, 40 delta is going to be the 27 strike. Okay, so as you can see, this is going to cost us $87 debit. Okay, so let's scroll down. Robinhood has added these nice P&L profit and loss charts here, which makes things easier when trading. So here, obviously, anytime we buy a call, your max profit is going to be unlimited. Okay. The max loss is going to be the debit paid, which is the debit paid was 87 cents. So that's our max loss. It's 87 times 100 because that 100 is the multiplier, contract multiplier. And then our break even point is going to be the strike plus the debit paid. So the strike was $27 plus the debit paid. So the break even point is going to be $27.87. Okay, so let's now turn this loan long call into a spread and watch what happens. Okay, so now let's go out. We're deciding to buy the 27 strikes. That's the 40 delta. Let's say we want to now sell the 20 delta. So this is buying the 40 delta, selling the 20 delta. Okay, so 29. There's 29 strikes right around 20 delta. So let's go ahead and turn this into a spread. All right, now look what just happened, okay? Not only, so first thing I noticed is that our max loss has decreased by 30 cents, okay? So we've now reduced our downside risk by a heck of a lot. Look at our upside risk. Before, our upside risk was, our upside profit potential was unlimited. Okay, so the one bad point is that we don't have unlimited gains, but not many times are stocks going to just explode 20%, 30%. I mean, maybe if you catch a lucky break with some of these growth stocks, or maybe one of these biotech companies that gets FDA approval or something like that. But personally, I think that's more like playing the lottery. But if you want a risk-defined strategy that can cap your losses, so we're capping our losses, and before our break-even was $27.87, we've reduced our break-even to $27.52. Okay, so it's still the strike, our long strike plus the debit paid. So 52 cents is the debit paid. Okay, and our losses or our gains get capped off when we hit that 29 strike at the top. Okay, anything over that, it's going to be the same profit. Okay, at expiration. So as you can see, this has made our not only has it reduced our break even, reduced our cost, but it's just a heck of a lot better strategy. So I'm gonna also highlight a couple other things that this also does. So long calls versus long spreads. We have our so for standalone longs, we have unlimited return with limited risk. Okay, we're not going to look at shorts here. Spreads, we're capping the risk, and the return is also capped. Okay, so this is the advantages of call spreads. We reduced the debit paid, which I highlighted. We went from 87 cents to 52 cents. We reduced the max loss, 87 to 52 is what we did. I'm going to demonstrate theta decay. We showed the break-even point gets lower here. We went from 27.87 to 27.52. And we increased the probability of profit, okay? Since our break-even point is now lower, the probability of us making money is now going to be higher, okay? So let me demonstrate on the Tastyworks platform, okay? Let us look at, we did the 30-day. So let me get this set up and I'll come right back. All right, we're going to use the Tasty Trade platform, not the website. So let's go to Tasty Trade. So we're back at our $27 call. Okay, so as you can see, our probability of profit is 28%. Okay, our delta is, we know what our delta is, but look at our theta. So we're going to lose. Basically 2 pennies, which is going to equate to $2 if you use the $100 multiplier. So if we have this call is going to cost us 90 cents. So basically every day we're going to lose 2 cents of that call if everything is held equal, if the volatility is held equal and the stock price is held equal. So let's say tomorrow the stock price doesn't go anywhere, the volatility doesn't change at all. Our theta decay would be 2, so our option would then be worth 88 cents. Okay, so now let's go back and add let's sell the further out of the money call. So let's go back to table. So I forget what did we say we were selling before. We were doing the 20 delta. So all right, so let's go back curve. All right, so now our probability of profit has been increased by 4%. So it went from 28% to 32%. Okay, now look at our theta. Okay, our theta is actually our theta is now half a penny, half a cent. Okay, so our new price is 52 cents. So if all things are held equal, tomorrow stock price and the volatility stays the same. Tomorrow, our contract would be worth 51.5 cents, or it wouldn't even, after 2 days, it would be worth 51 cents. Okay, so you can see that you have a lot better of an advantage in terms of reducing your theta risk. We also reduced our directional exposure from 40. The call by itself was 40 delta. Now our directional exposure is 20 delta. Okay. So yeah, in many ways, this is a superior strategy than just buying a naked call, because of how far you have to be. Not only do you have to be right, you have to be very right. Okay. And by implementing this strategy, you can perform better than like 99% of the Robinhood traders out there that are just blindly buying calls and puts, naked calls and puts, without knowing anything about theta decay, break-even points, probability of profit, and all of that. So I hope this helps. If you like this stuff, subscribe and like my videos. And as always, this is for educational purposes and shouldn't be considered any type of financial advice. Alrighty, take care. Peace out. Bye-bye.